Well, good morning. I'm Jagendra Rana. The topic of the day is merger and acquisitions in Indian insurance sector. Merger and acquisitions in Indian insurance sector. Having raised rupees 1930 crore in financial year 2023, the insurance sector may witness further capital transactions including stock market listings and merger and acquisitions to improve this sector's capital adequacy and financial flexibility in the months ahead. Indian insurers' favorable growth prospects have encouraged the sector to raise capital, outweighing the adverse impact of their weak underwriting profitability. In financial year 2023, the sector's paid capital rose to 75,300 crore from rupees 73,400 crore a year earlier. So that is an increase of 2.6%. It is expected that more such transactions will be there, as well as more merger and acquisitions deals and initial public offerings are there to improve the Indian insurance sector's capital adequacy and financial flexibility in the months ahead. Foreign insurers would continue investing in the Indian insurance market, and many foreign companies already present in the country through joint ventures could seek to increase their ownership stakes in their Indian affiliates. So we believe the presence of foreign stakeholders brings particular benefit in the areas of capital adequacy, financial flexibility and governance standards. The raising of limit on foreign ownership of insurance companies has been credit positive for the market. India's privately owned insurers where foreign shareholdings are concentrated have cut their exposure to high risk assets and have been early adopters of actuarial led reserve management and risk based capital management. This will help private insurers reap benefits of India's economic growth. However, the general insurance sector's result remained negative as rising claims posted to an underwriting loss. A sustained increase in prices as a result of the government's reform program would significantly improve the sector's underwriting performance and profitability. So, despite a decline in outbound merger and acquisition activities to $570.3 million in the first quarter of 2024, Indian operations are poised to pursue international deals amidst global inflationary pressures. The value of merger and acquisition deals surged by 60% to $19.6 billion in quarter 1 2024, highlighting robust domestic deal making capabilities despite some moderations in private equity transactions. India is the underpenetrated market and there is a huge potential for merger and acquisition insurance in the country. There is still work to be done, but the message is being heard, and the onus is on the broking community to continue to communicate the value of merger and acquisition insurance to clients. The earlier merger and acquisition stakeholders engaged with us in the same way as is now commonplace in US and European deals. the more we can do to protect and expedite the transactions. The financial services sector, contributing significantly to India's economy at 10.6%, saw notable merger and acquisition activities with transactions like the merger of HDFC, not HDFC, IDFC First and IDFC Bank, reflecting ongoing consolidation and regulatory dynamics shaping the industry. So, innovative insurance products are reshaping India's insurance landscape, with merger and acquisition insurance evolving to support cross-border merger and acquisition trends. The market has seen increased participation from insurers and managing general agents, intensifying competition and driving down insurance rates from previously higher levels to between 1% and 2.5% depending on the transaction type. India's economic trajectory points towards becoming the world's third largest economy by 2027. So, buoyed by investor-friendly reforms, robust domestic savings, and heightened foreign investments. The outlook for 2024 remains optimistic, driven by structural reforms, favorable valuations in private equity, advancements in AI sector consolidations, and robust adoption of environmental, social, and governance strategies. So, key sectors like healthcare, renewable energy, infrastructure, manufacturing, and financial services are witnessing heightened merger and acquisition activities. So, this M&A, merger and acquisition insurance, has emerged as a capital risk management tool for both domestic and international firms, with growing awareness of its benefits. Increased competition in the M&A insurance market is expected to lead to lower rates and broader coverage options over the next year. Looking ahead, India's evolving insurance market and dynamic merger and acquisition activities or landscape are set to continue attracting attention and investments, supported by competitive insurance solutions and strategic merger and acquisition initiatives across key sectors. So, the insurance sector in India is poised to witness a surge in merger and acquisitions, capturing the interest of both strategic and financial investors. Recent industry analysis by the Confederation of India and KPMG highlights the growing opportunities in this market driven by liberalization of foreign investment regulations, a growing emphasis on stock market listings, and regulatory support to fulfill the Indian government's ambitious vision for the sector. For the government's Insurance for All by 2047 program, designed to coincide with the India's centenary of independence, aims to achieve universal insurance coverage through the deployment of digital distribution channels, innovative products for underserved segments, and simplified claim processes, particularly in rural areas. Rising M&A activities in Indian insurance sector can be seen. The Indian insurance industry has experienced notable levels of merger and acquisition activities in recent years, driven by evolving consumer needs, technology adoption, and the entry of international players seeking to tap into one of the world's most promising markets. This trend has been fueled by the sheer size of India's underinsured population and the increasing demand for diversified insurance products. So it is underscored by high-profile transactions such as Zurich Insurance Group's recent acquisition of a 70% stake in Kotak Mahindra General Insurance for approximately INR 4,051 crore, that is US dollar 488 million. Which notably represents the first outright control deal under recently liberalized foreign investment regulations that now permit increased foreign ownership in Indian companies. So transactions such as this highlight global insurers' ongoing interest in India's dynamic insurance landscape, emphasizing the market potential for long-term stable growth. Secondly, proposed changes to foreign direct investment in insurance. In a significant policy shift, IRDAI chairman recently advocated for the current 74% cap on foreign direct investment in the insurance sector to be lifted, arguing that India's ambitious insurance coverage goals will not be met without substantial international investments. This proposed reform would allow foreign investors to own 100% of Indian insurance companies, eliminating formal requirements to partner with local insurance firms. So currently the existing FDI cap necessitates that foreign insurers partner with Indian companies, often resulting in complex ownership structures. While the proposed reform would allow for full foreign ownership, many international investors may still prefer to enter the market through joint venture with Indian partners, particularly in the initial stage. This preference often stems from the significant value that local partners bring, deep understanding of India's diverse customer preferences, established distribution network, experience in navigating regulatory requirements, and existing relationship with key stakeholders. The key advantage of the FDI liberalization is therefore less the option for an outright acquisition of Indian insurance assets, but rather the ability to restructure insurance partnerships more flexibly, incorporating sophisticated investment structures akin to those commonly seen in other developed markets. For instance, shareholders' agreements could include more robust put and call options that enable phased transition to greater foreign ownership, or alternatively include predetermined IPO or exit mechanism that align with common global portfolio strategies. So this flexibility would allow foreign investors to benefit from local expertise while maintaining clear partners or clear pathways to increase controlled public listing or exit as their Indian operations mature. So the importance of creating a more flexible regulatory framework that allows international investors to adjust their investment structure as their strategies evolve is also highlighted by the recent market discussions around Allianz's potential restructuring of its joint venture in India. Then FEMA pricing rules. Although these proposed FDI reforms would mark significant progress if implemented, the Foreign Exchange Management Act pricing regulations for unlisted securities remain a barrier to optimal investment structuring. Currently, FEMA requires transactions in unlisted securities to occur at fair market value, limiting the ability to negotiate prices that reflect strategic considerations, such as below market transfers in specific exit scenarios. In default scenarios, as an incentive structure or flexible pricing arrangements for phased ownership transitions. So allowing investors to have more flexibility in these type of valuation arrangements would align India's regulatory framework with international standards, enhancing its appeal to foreign investors seeking market standards investment options. And IRDAI push for increased listing and market transparency. IRDAI chairman has also encouraged large conglomerates to enter the insurance sector and also suggested that existing private insurance businesses should consider going public. Market listing offer multiple benefits, enhancing transparency, encouraging higher governance standards, and providing more reliable information for shareholders and other stakeholders. Noting the usual developing market risks that continue to require analysis. So for global investors, this drive towards transparency and public accountability could further enhance the appeal of the Indian market. Now, listing on the capital market offers a dual advantage for investors. For domestic insurers, public offerings provide a means of accessing capital while enhancing corporate visibility. For foreign investors, listing present potential exit opportunities, allowing them to monetize their investments or reduce exposure as the market matures. As more insurers join public markets, increased visibility into their operations, financial and risk management practices may further encourage investments from diverse classes of investors such as sovereign wealth funds, pension funds, and private equity. And the next one is strategic considerations for international investors with a more favorable regulatory environment on the horizon. Both private equity investors and strategics may find the Indian insurance sector increasingly accessible and attractive. However, entering or expanding in this market also requires strategic foresights and risk management. Investors should consider the following factors as they evaluate opportunities in Indian insurance. Understanding regulatory compliance. India's regulatory framework is evolving rapidly. Investors should stay informed about updates from IRDAI, particularly around FDI and public listing requirements, and evaluating partnership options, even with the prospects of 100% FDI. Partnership with domestic players remains strategically valuable, especially for companies familiar with local regulatory and market dynamics. So the proposed regulatory changes should be viewed primarily as enabling more sophisticated joint venture structures rather than as an invitation for outright acquisitions. So local entrepreneurs can offer crucial insights into customer preferences, regulatory requirements, and distribution channels, while the relaxation of FDI restrictions would allow these partnerships to be structured with greater flexibility to accommodate evolving business needs and market conditions. Then the leveraging digital innovation, ESG considerations, so with the potential for full foreign ownership and increase in public listing and a commitment from regulator to foster a robust insurance ecosystem. The Indian insurance market presents highly attractive opportunities for strategic investors and private equity sponsors alike. By staying attuned to these developments, understanding regulatory shifts, and crafting strategies tailored to the Indian market, investors can position themselves to capitalize on India's growing insurance needs and its vision of insurance for all by 2047. Thank you very much.